there. My name is Joanna Bramer. I am the CEO and Principal Consultant for Lighthouse Advisory. I wanted to talk to you today a little bit about financial reports and understanding the financial reports for your own business. Tools like QuickBooks or Zoho or other accounting systems are wonderful for capturing transactions, preparing reports for taxes, and organizing your financial reports in general. But do you really understand how to interpret those reports and understand the profitability of your business? I'm going to walk through a couple things that I like to go through with my clients on a monthly basis to show you the information that you can get out of your financial system. So on any given month, I like to go over a client's financial reporting and analysis for that month. The first thing I like to talk about are their cash forecasting. So this is a tool that QuickBooks is starting to implement in some of their users, but it's truly not a fully vetted report just yet. And so I find that doing this offline with the detailed information I have for each of my clients is the most useful way to get to this information. So a couple of things I'd like to point out. First are the average monthly expenses. This is something, driven from your budget or known expenses when they're going to hit. For a forecasting perspective, you always want to know what's your available cash balance and how many months is that going to carry you forward. So in this case, our example business has about $250,000 sitting in the bank, and that will carry them for the next 5.5 months with no additional income. The cash flow projections, as you can see, we are starting into April. So we have actual information for January through March, and then we have projections for the remainder of the year as compared to the prior year. And then the average is the yellow line going across. So that helps the business owner understand, where am I? Where do I expect things to be? Where's my low point? Am I ever going to be too short on cash to continue operations? And it gives a good picture of how healthy they are for moving forward. All right, the next area I like to focus on is income. So there's a couple ways you can look at it. One is based on a quarterly projection. So where you are and where you would expect to be for the first quarter of the year, for example. The thermometer to the right would be the annual goal and how far you've gone towards reaching your annual goal. And then looking at it from a monthly perspective, what did you expect to bring in each month? Did you meet that? And does your goal for the months going forward need to be adjusted in order to take that into account? You can also look at different lines of business. So what do you expect your lines of business to be from an income perspective? How much are you planning to get from each line of business, and where are you actually? Do you need to be focusing on one line of business over another based on where you anticipate the income to come from? And then down at the bottom, that's just another way to look at the same information. So the percentage towards your goal, as well as the actual income per line of business and the goal per line of business. Your expenses. So the next two slides focus on expenses, the first on cost of goods sold and the next on overhead expenses. Again, looking at your actual spend versus your goal and what your goal may need to be adjusted to address. In this instance, there was a little bit of an underspend, even though the first month spiked in cost of goods sold spending. The following 2 months were a little bit more conservative, and so the goal doesn't need to be adjusted very much. The thermometer again on the right shows you where you are for the whole year. And then the top, your quarter to date progress. So looking at a 3-month period, where are you on reaching your goal or keeping yourself under budget? So again, this is the same information, but just for overhead expenses. So those expenses that are not directly aligned to your business and delivering goods and services. In this instance, you'll typically see overhead expenses be a little bit more level. In this case, or this example, spending was lower than expected. And so come April, we may have an increased budget for overhead expenses. Some expenses come in once a year, some are a monthly fee recurring. So throughout the year, you'll see these goals shift in order to adjust for when you expect expenses to come in. This next one is one of my favorites, taking a deeper dive into overhead spending. This looks at the actual dollar value of spending. So those are the bar graphs versus the percent to budget in the dark blue line graph. So that line graph shows you how close you are to meeting your budget for the year. But for example, other business expenses here spikes fairly high, but the actual dollar amount is not as low. So it gives the business owner a little bit of perspective in seeing if they're close to their budget on a specific line item, how much of their actual spend does that line item make up? If you see the yellow line going across the center, that's at the 25% mark. So that shows us that we are 1 quarter through the fiscal year for this business. And that can show you specifically which line items spike over that, which means they're overburning or they're overspending beyond what we expected for this point in the calendar year. All right, and then our final slide is focusing on net income for the business owner. Your income, total income, less cost of goods sold and any overhead expenses. At certain points in any given year, you may expect to see a negative net income. A lot of that can be timing due to when the expenses, if you put a lot of upfront costs into delivering a service or getting inventory ready to be sold, you may expect to see net income. And then as it's actually sold or delivered or invoices are paid, you would see the net income spike higher to make up for that. So this shows us where we are for the year versus where we expect to be. And you'll notice some goals, and even in the prior year, dip below negative for that exact timing difference. And then on the right-hand side, we've got where we stand for the current year. So where we expect to be at the end of the year, where we currently are, and what the prior year ending net income was. So I hope this was helpful in understanding how you can break down financial reports. I look forward to chatting with you in the future, and please reach out if you have any questions.